Didier Sornette, Why Stock Markets Crash, Critical Events in Complex Financial Systems. Embark on a thrilling exploration of the complex world of stock market crashes in the book, Why Stock Markets Crash, Critical Events in Complex Financial Systems by Didier Sornette. Unravel the intricate mechanisms and processes that take place behind the scenes, driving these colossal financial events. Prepare to dive deep into several case studies, including the infamous Black Monday crash of 1987 and the Great Depression of 1929. Sornette debunks common misconceptions surrounding external factors as the root cause of market crashes, and instead argues that it's the cumulative effects of long-range correlations and systemic market instability that lead to these catastrophic upheavals. Along the way, discover how human psychology, herd mentality, and market bubbles play a major role in shaping market behavior.
Understanding stock market crashes. Stock market crashes are often attributed to sudden external events, but in reality, they are caused by market instability that builds up over time. Such instability creates a global cooperative behavior that eventually leads to collapse. While some factors may exacerbate the crash, the specific cause is difficult to pinpoint. Market crashes follow bubbles, characterized by speculation and imitation. Even though they seem unpredictable, the signs of a crash are subtle but discernible. The market proves to be self-organizing in such events. The lessons from Black Monday. The 1987 stock market crash, known as Black Monday, was a shock to investors who were optimistic about the market's future. The Dow Jones Industrial Average dropped 508 points, devaluing all U.S. stocks by $1 trillion. However, within 15 months, the Dow returned to its pre-crash levels, and the Standard & Poor's 500 bounced back in less than 2 years. The crash was triggered by a superagent created by traders engaging in unison behavior that ultimately broke apart after the crash. The crash wasn't an indication of mass hysteria, but a return to a rational and widely accepted valuation. The book emphasizes the importance of carefully monitoring warning signals in the stock market and offers a lesson on the systematic instabilities that may arise due to human behavior in financial markets. Bridging science and finance. The market is similar to systems found in nature and engineering. It may be complex but coherent. Blaming external factors, such as programmed trading for market crashes, is like blaming restaurant waiters for obesity. The Tacoma Narrows Bridge collapse of 1940 serves as a good example. The bridge fell apart because of the instability built into it, and not simply because of high winds. Similarly, financial markets collapse as a result of the instability within the system, speculators seizing upon the instability created by the herd mentality of traders and investors. The influence of cognitive biases, emotional quirks, and social factors further hampering investors' rationality. The opening of financial sectors to foreign entities creates too much capital, leading to developing countries' financial markets instability. Applying science to financial endeavors can provide insight into the complexities inherent within the market. The psychology of market crashes. Market crashes throughout history have been shaped by herd mentality, human psychology, and unrealistic optimism. This phenomenon is evident in the 1929 and 1987 stock market crashes, as well as in 3 other crashes that occurred in the U.S. In each of these crashes, a bubble preceded the market crash, causing a self-perpetuating cycle of crowd behavior. The book highlights how lack of consumer confidence caused the 1929 crash to lead to a long depression. The crash of 1987, however, did not result in a long depression but still had a significant effect on the economy. In both crashes, human behavior played a key role. Humans are biologically prone to teeter between greed and fear, which leads to instinctive psychology during mass panics. Investors were initially optimistic, but that optimism went too far, leading to unrealistic overvaluation. With similarities in the general conditions in all market crashes, the book explores the phenomenon of herd mentality and the role of human psychology in shaping the world market. Understanding the rationality and herd behavior driving financial markets. The random walk theory and efficient market hypothesis suggest that markets are rational and impossible to beat in the long term. However, human behaviors and thought processes such as herding, overconfidence, and misguided thinking undermine this theory. Investors' decisions are affected by their individual emotional eccentricities, by the power of mass psychology, by their risk tolerance, and by simple misguided thinking. This article explores the different types of herding that occur in financial markets and how they can have striking effects on bubbles and crashes. Two models, the risk-driven model and the price-driven model, help predict a crash by reconciling the differences between rational traders and noise traders. These models acknowledge the market's nuanced, self-organizing behavior, which is apparent in crashes. By understanding the rationality in herd behavior driving financial markets, investors can have better insight into market dynamics and make more informed decisions.
In conclusion, Why Stock Markets Crash takes an insightful and in-depth look at the true roots of financial market crashes. The author, Didier Sornette, proficiently establishes that these events are not random anomalies but rather a consequence of a slow buildup of correlations, coupled with market instability and human behavior. The book sheds light on crucial concepts such as human psychology, herd mentality, and the role of market bubbles in precursing crashes. Sornette provides a refreshing perspective on understanding the seemingly chaotic and unpredictable nature of stock market crashes, by outlining the significance of self-organization and the subtle signs of an upcoming collapse. Gain a new understanding of these complex financial systems, and be better equipped to discern fact from fiction when navigating the volatile world of stock markets.